Okay, we're kicking off today's deep dive with I think, a pretty bold claim. Warren Buffett,
Hmm.
the man who practically defined modern wealth.
Hmm.
He doesn't credit his success to some secret algorithm. He credits one man, Benjamin Graham.
It's a huge endorsement. I mean, Buffett says Graham was the single biggest influence on his life, right after his own father. And so today, we are diving into Graham's Bible, The Intelligent Investor.
Right. But we should probably clarify something right at the top, because that title, it could be a little misleading.
Oh, absolutely. This isn't a get-rich-quick book.
Not at all.
It's more of a don't-get-poor manual. Graham wasn't really interested in making you a millionaire overnight. He was obsessed with teaching you how not to lose everything you have.
And that makes so much sense when you look at his own story. I mean, he didn't just study market crashes from a textbook.
No, he lived them. He was born into poverty. He actually watched his mother get completely wiped out in the panic of 1907. And that trauma. That really is the key to this whole philosophy. He saw Wall Street not as a casino, but as this dangerous machine that could just chew you up.
So that's where he draws this hard line between investment and speculation. To most people, buying a stock is just buying a stock.
But to him, there was a massive difference. Think of it like buying a business versus just betting on a horse race.
Okay.
An investment for Graham is an operation where, after you do thorough analysis, you can promise yourself safety of your principal and an adequate return. Anything else?
Just gambling.
It's speculation. Exactly.
Well, I guess the argument from the other side would be, well, if you're smart enough, you can outsmart the crowd, right?
Yeah.
You can time those gambles.
You'd think so. But Graham loved to point out that a high IQ can actually be a liability. He always used the example of Sir Isaac Newton.
Wait, the guy who invented calculus couldn't handle a stock portfolio.
He lost a fortune, a complete fortune in the South Sea bubble.
No way.
Yeah, and he famously said, "I can calculate the motions of heavenly bodies, but not the madness of people."
Honestly, that's terrifying. If Isaac Newton can't beat the market, what chance do the rest of us have?
And that's Graham's whole point. You don't need to be a genius. You need discipline. He argued your world enemy isn't the economy or some bad stock pick. It's you. It's your own mind.
Which brings us to my favorite of his ideas, Mr. Market. It's just such a perfect way to visualize that madness he's talking about.
It's a brilliant psychological trick. So Graham says to imagine you have a business partner. His name is Mr. Market. Every day he comes to your office and offers to either buy your share of the business or sell you his.
The catch being that he's completely unstable.
Totally. He's a manic depressive. Some days he's euphoric, thinks the business is the greatest thing ever, and offers you a ridiculously high price.
And other days he's panicking.
Convinced the world is ending and will sell you his share for, pennies on the dollar.
And the mistake most people make is they let his mood affect their mood.
Exactly. They get scared when he's scared. Graham says, no. Mr. Market is there to serve you, not to guide you. When he's manic, maybe you sell to him. When he's depressed, you buy from him. You have to be the rational one.
Okay, so if we're going to be the rational one, how do we actually build a strategy? I always thought you picked one based on your risk tolerance.
That's the common way of thinking, but Graham flips it. He says it's not about your risk tolerance, it's about your effort tolerance.
Your effort tolerance.
Yeah. How much work are you actually willing to put in?
So if I have zero interest in spending my weekends reading annual reports,
then you are a defensive investor. You want safety and freedom from bother. So you buy index funds, high-grade bonds, and you basically set it and forget it.
and what if I do want to try and find those hidden gems?
Then you can be an enterprising investor, but Graham's warning is that it has to be treated like a full-time job. You're running a business.
Right.
The real danger is being stuck in the middle. Doing just a little bit of research gives you just enough confidence to make a really big mistake.
It's all or nothing. Okay, we have to talk about the 3 words that Buffett himself says are the most important in investing. Margin of safety.
This is the secret sauce. So imagine you're building a bridge. You know for a fact that a 10,000-pound truck has to cross it.
Mm-hmm.
Do you build that bridge to hold exactly 10,000 pounds?
Absolutely not. You build it to hold, what, 30,000 pounds? You need a buffer.
You need a buffer. That's the margin of safety. In investing, if your research says a company is worth $83 million, you don't buy the stock when the company is valued at $80 million.
Too close to the edge.
Way too close. You wait until Mr. Market is having a really bad day and you can buy it for $40 million.
So you're basically buying $1 for 50 cents.
And that gap, that margin, That is what protects you. It absorbs your mistakes. It absorbs bad luck. It makes predicting the future totally unnecessary.
And you see how timeless that is. You just have to look at something like the dot-com bubble. All those companies worth billions one day and, basically zero the next.
A margin of safety would have saved so many people. It all comes back to managing risk, not trying to avoid it completely.
So I guess the final question for you to think about is this. If the biggest risk isn't in the market, but in the mirror, do you have the emotional discipline to ignore Mr. Market when he's screaming? Or are you just one of the crowd following his lead?
That really is the multi-million-dollar question, isn't it?